Hi everyone, thanks for joining us for this webinar entitled What is the Future for India within Global Coal Dynamics Markets. Today we've got two speakers lined up, Rodrigo Echeverri and Ashwani Raina. Ashwani is the head of coal sourcing team for Essar Power. He has more than 25 years of rich experience in commodities comprising of coal, ferrous and non-ferrous metals and iron ore. And previously, he has overseen various assignments across strategic sourcing, international project management, M&A, business development, sales and marketing, and mining. Also today we have, as I mentioned, Rodrigo Echeverri. He is the head of energy coal analysis at Noble Resources International. He has worked in the industry since 2004 and has previously held sales and analysis roles for Sirahon, Adaro, and the energy think tank Capsark. So the order of the day today will be opening with Ashwani, who's going to be discussing the current state of the coal market in India from the power perspective primarily. And then we'll turn over to Rodrigo, who's looking at India within larger global trends in today's market. And then finally, we'll have a Q&A session after the presentation. So please do send in your questions. If you have any, you should see a small box on your screen with which you should be able to write in questions, and it will be great to hear from you. So with that, let's hand over to Ashwani, who'll be looking at the state of the Indian market.
Hi, good afternoon, everybody. Very interesting topic, future of India within global market. Before I begin, I just wanted to tell you something about what happened a couple of weeks back. I was there in a meeting with the top management of Coal India Limited, and you will not be surprised to know that they started talking about exporting coal from India. That's very interesting. So probably that's going to be the future of India in coming years, vis-a-vis coal. Anyway, just to begin with our session today, I just wanted to give an overview of what's happening in India related to coal. And as you know that India is producing almost 1100 billion units of electricity today, and it's the third largest producer and fourth largest consumer of electricity in the world. In spite of that, the per capita consumption in India is quite low, which shows that there is huge potential for growth of electricity and thus demand of coal. Right? Just to begin with, I would like to take you through a couple of slides. 2020 is considered to be a very important year for India because Government of India has declared that by this year we will touch a target of 1.5 billion tons of coal production. Let's see what's going to be the demand side like in 2020. Coal is mainly consumed in power sector, steel, cement, and other industries in India. If you see that currently in 2015, the total demand of these sectors was close to 830 million tons. And going forward, if you look at 2020, considering that India grows at a GDP rate of 7 to 8%, we expect that the total coal demand in India will go to around 1.3 billion.
Hi, Ashwani. A quick point. Could you just open your slides on the screen? You need to accept on the webinar. We can't.
I have opened my slide. Are you able to see it?
Yeah, perfect. Sorry, thanks. Yeah, sorry, continue.
Okay, sorry. So we were talking about 20. I think you were able to hear me, right?
Yes.
Okay. So we are talking about 2020. I have just to give an overview of how the coal demand is going to be translating into India. Power is going to be the dominant player of coal, and it will consume close to 950 million units. Today we have an installed capacity of 190 gigawatts, and which is going to increase to almost 230 gigawatts by 2020. So this translates into a requirement of around 950 million tons of coal for power sector itself. Now, the second most important sector which consumes coal in India is steel. The requirement is going to go from almost 75 million tons to 95 million tons by 2020. When today India is the third largest producer of steel in the world and producing almost close to 95 million tons. and it is expected that we will reach a number of around 175 million tons going forward by 2020. So total coking coal plus thermal coal put together, the demand will be somewhere around 95 to 100 million tons. Another sector which consumes a chunk of coal in India is cement. India is the second largest producer and consumer of cement, with the current capacity of around 360 million tons. In 2015, we produced close to 285 million tons. Again, considering a growth of around 7 to 8% in cement production, we will be touching almost 390 to 400 million tons by 2020. And the demand for coal in this sector will come to around close to 60 million tons. There are lots of other sectors, small sectors like paper mills, you have ceramic tiles, you have brick kiln, you have textiles, fertilizers, and many other sectors, small sectors. They all put together with a GDP growth of around 7 to 8%. We expect that the requirement from this sector will go up from current 180, 190 million tons to 250 million tons. So going forward, the demand is expected to reach to around 1.3 billion tons by 2020. Now, we'll just try to cover up the supply side, how this demand is going to be met. Well, Government of India has very ambitious plans, and in fact, Ministry is working on no imports. That is the philosophy, but we will cover that part later. Here, I just wanted to give you a very, very optimistic situation wherein we expect that India will be producing almost 1.5 billion tons of coal by 2020. Majority of this will come from, almost 1 billion ton has to come from Coal India, with around 0.1 billion, that's 100 million tons, will be covered by Singareni coal. And another 400 million tons is expected to come from other private sectors, state sector and central sector PSUs. If you see, Coal India and Singareni put together produce around 600 million tons in financial year 15. And this year, the production target of Coal India itself is 595 million tons. Though till December, it has been lagging by almost 10%. However, stakeholders are confident that they will be able to achieve this number. And as our Minister, Mr. Piyush Goyal, said, that none of the plants will go dry without coal. Production from the captive coal blocks, which were earlier deallocated and reallocated, and the other coal blocks which were already not deallocated or reallocated, it is expected that from all these coal blocks, the total production will be around 400 million tons. So put together, we will be reaching a target of 1.5 billion tons by 2020. Coal India has drawn up a substantially vast production plan for each and every subsidiary, and they have gone to the level of each and every mine. And with this, if you see on the right side of your screen, we have given each and every subsidiary wise the targets of production for starting from 2015-16 till 2019-20, when it is expected to reach 1 billion tons. Meeting 1 billion ton production is definitely a challenge, because there are two types of challenges, which recently we have witnessed one more challenge, which is from the demand side. Basically, the demand has slightly gone down in the last 3-4 months. However, when we look at the larger picture of it, 1.5 billion tons, everybody considers to be a big challenge, given the logistical challenges which we'll be having. And coal is mostly concentrated in the eastern part of India, whereas most of the consumption areas are in the northwest. Consumption areas are in the north and west. Having said that, there is I think, Ministry of Coal, along with Ministry of Railways and Ministry of Power, they're working in tandem. Ministry of Environment and Forest, they're also working very closely with them, and all the issues are getting sorted out on war footing. So we do hope that we are on the right track to reach to a level of 1.5 billion tons by 2020. Now, an important question is, what will happen to the imports? Are the imports going to go down? This is a question which, in fact, whenever I interact with people in any forum, this is the first question they ask, that what's going to happen to the imports, because they feel that India still needs large volumes of electricity for its growth, and Coal India may not be able to keep up the pace which it is expected to do. And then what's going to happen to the coastal power plants which are based on imported coal? Let me tell you that there is definitely a thrust on import substitution. If you see 2016, there was a drop of almost 8% in imports. And if you look at steam coal, the steam coal has dropped by almost 11%. Government of India is pursuing import substitution vigorously and has launched a host of schemes to achieve the same. Just to give you an idea, what's happening, see, coal availability for thermal power plants has been improved drastically. As I said, that major consuming areas are in north and west. And earlier, coal in India was some sort of a controlled commodity. But now, with the change of mindset, there are lots of provisions which have been brought into the industry. The first thing which they started with was swaps. There was a lot of coal movement happening from east to west and east to north. And there were lots of, say, less efficient power plants located in these areas. Now, Government of India has allowed swaps within a company. If you have a power plant, or within the two companies also, now it is being extended to the private sector too. Till now, it was extended to the government companies only. So today, NTPC or Gujarat government, they can swap their coal to have a better utilization of to have a better utilization. Number two, there is a drastic improvement in the quality of the coal which is being shipped. If you have lesser logistics involved and the quality improves, even if there is a quality improvement of 10%, that drastically cuts down your coal requirement by almost 10%. Power plants, there was huge quantity of spare capacity lying idle, particularly in the hinterland of India. Now, which this quantity was not I think this installed capacity was not able to generate because of non-availability of coal. Coal India has come up with lots of e-auction plans, wherein now these power plants are getting sufficient coal and they have started producing power. With the result, what has happened? A substantial volume of power is now getting generated from the power plants which are located nearer to the coal mines. And it is power which is getting transported to different regions of northern India and southern or western India, right? So these are certain steps which Government of India has taken, and if you see, they have already declared that there will not be any import of coal by government sector in 2017. Still, a lot of apprehensions are being raised on whether imported coal will be replaced on the power plants which are located on the coast and which are based on imported power plants. Coal. Well, my answer to this is that though it appears that logically it appears that these plants will continue to be fed by the imported coal, but that will be at a price. Today, Government of India has identified specific mines in Eastern Coalfield and Southeastern Coalfield Limited, which is high calorific coal, low ash content, good in quality, which can be shipped from eastern part of India to even western part of India, coastal power plants in the western part of India. So there is a lot of thrust. There are, in fact, there are various meetings which are happening between Coal India, the power producers, Ministry of Railways, to work on the import substitution. Having said that, our feeling is that probably in any case the imports have already peaked in 2015. We believe that now they have started tapering down, and we expect that a level of around 80 to 100 million tons is what it can stabilize at those levels. Thank you very much. This is the whole story in India. Any questions, Anas?
So we're going to do questions at the end once we've seen both presentations. So thank you, Ashwani, for that presentation on the Indian market. And now we're passing over to Rodrigo, who will be looking at global trends.
Let me know if anything goes wrong there, please.
we will do.
Have we seen? Can you see my presentation?
Yeah, we can see the slides in the PowerPoint.
You can see the slides in the PowerPoint. Sorry, 1 second there.
No problem.
Make it full screen. Okay, probably doesn't want to show. Is that okay?
Yeah, it's fine.
Okay, so hello. As Harry said, my name is Rodrigo Echeverri, and I work for Noble Resources in Singapore. Today, I wanted to talk about three different topics, but I guess they are all parts of a same topic, and is that the concept that the international coal market is quite interconnected. So the first thing I will do is talk about what recently happened in 2016, because I guess there are still those who are actually wondering what changed in the market and why the prices, the price environment turned. And the other one is probably similar to what Ashwani just did with the balance of coal in India. I'll present our own results and then I'll move on to try to show our models for the overall seaborne market. Though I understand that I'm still having some problems with the screen. Is that
I think
it's my computer refused to do full screen. Okay, so I'll continue from here. That's fine. To some people in the market, it was a surprise that prices turned in at the beginning of 2016. I don't want to say that we have a crystal ball here, but actually there were a lot of elements in the market already yelling that things couldn't continue the same way they were going. Basically, we saw an incredibly bearish market there in Q1 16 with many factors converging, the subject of which is actually a longer presentation that I will be giving in Cape Town later this week. But in summary, I would say, well, one, we had a very pressurized coal market over 5 years where you had not bad demand actually, but you had a lot of supply coming online in 11 and 12, which put pressure on prices going forward with a demand shock, basically China coming in and exiting as well. So very unpredictable demand base and a lot of capacity overhang. So that kept prices depressed about 5 years. So what happened actually, it was that we believe that at some point in about 2014, the market had overshot when we actually went below the $80 level for, say, API 4 on Newcastle. We believe that at that level, the market had already overreacted and was already getting ahead of itself in a way. And that was exacerbated by a correction in international oil prices that went from $110 to $50, and then gas prices followed. So we were in an environment that was exceptionally bad for energy commodities, all commodities actually, but energy commodities in particular. And it was something that for some, it was hard to explain how things could continue based on fundamentals, on the cost of production for many basins, etc. So just to summarize what happened in the market, just a bit of a high-level view there is the way the market balanced last year. The first thing that comes to mind is that there was a demand shock that came from China, and that is this huge green block that you have over there, that plus 43 million tons growth in demand. And it is very tempting to say that everything that happened last year had to do with China. But I am actually, I do not adhere to that view. I actually believe that the market last year from the demand side was not much different to the market that we had in 2012. 2012 is a year where China came with an increase in demand of 70 million tons, so it was actually larger, and actually India was still growing. So on the demand side, we have many shocks, but what happened is that the capacity in the international market was so high that there was enough to respond to that incremental supply demand, and hence the prices in 2012 will actually continue to go down. In 2016, if you think about it, things were a little different. One is that, well, yes, you had a little bit of extra demand that was not really expected, and that's what we would call a demand shock. But that overall, if you think about it, the whole seaborne demand only grew about 11 million tons globally. But what happened importantly was also on the other side of the equation, on the supply side, how, for example, Indonesia responded. And the answer is, well, Indonesia is actually did not respond very much. If anything, Indonesia remained almost flat. Though in Indonesia, production actually grew, but most of the growth in production was absorbed by the domestic market. Another one market that was very interesting, origin, was Australia. Australia only supplied about 1 million, but basically flat year on year, 1 million tons extra, and that's because Australia was too busy actually selling metallurgical coal at high prices. So you had a combination of that, Russia coming in really well, but some of that would have been actually favorable currency conditions from the beginning of the year because the ruble follows oil prices. And oil prices were low in the first half of the year, so you had a lot of tailwind for Russians to export more, and that's almost actually turned around. Well, not fully, but the ruble is going a different direction with the price correction upwards of the oil. Colombia was expected and welcoming and would come no matter what, so there was an increase there of 8 million tons. So we had some supply, some would say some supply response. I would say some supply conditions. So the Colombia one is one that would have happened, but the Russian one could happen or not happen, and then bits and pieces here and there. And very difficult actually to get the supply to come quickly enough, for example, in Q4. So if we look at the chart that we utilize, we use here in Noble to gauge how the market is behaving, there is this concept of capacity utilization, because in order to really explain prices, you have to get into the dynamic of who is pulling what. So, you know, whether the demand is pulling or the supply is pulling, what's really leading the market. So a high capacity utilization really means the demand pulling on the market and trying to get that marginal ton because they need it. And what we saw was an incredible change in the shape of this chart last year, and it went basically to a 10-year high, and that was because you, after 5 years of very depressed prices, you didn't have a very good supply base globally, and that really affected the ability, for example, for Indonesia to respond and others, right? So that's what happened in 2016 now. On the argument of China, yes, there was a change. There was a policy change, and that had a massive impact as well that was, I guess, the driver of the main demand shock that we saw last year. And what happened is the government actually reviewed downward, started controlling the amount of production that was going to be available by decreasing the number of days that mines could operate. So the result actually is on the chart on the left. We see a decline, quite a sharp decline in raw coal production in China. And we actually see a thermal coal demand that had been decreasing and actually stopped decreasing last year. So on the right-hand side, you can see how the price reacted to all of that, and it's Qinhuangdao prices almost reaching levels of 2011 at almost 800 RMB. So quite a spectacular, very quick increase in Chinese domestic prices that actually made Chinese traders and utilities very aggressive in the international market in Q4 when they were really booking the cargoes to restock for Q4 for the winter. Now, in short terms here, you can see generation and well, thermal generation, which means gas and coal. And one remarkable thing is that and one of the reasons the prices went up so quickly, it was because there was a control on the supply side. But actually, unexpectedly, the second half of 2016 had very good demand for electricity in China. So demand that had been very muted for the previous 2 years actually rushed really high, and it had to do with hydro, and it had to do with stimulus, and it had to do with a few things. But actually, that was the result. It was overall a 6% increase in electricity generation. That was quite a healthy level of growth. So like, you could argue that in China, shocks came from both sides. Now, going forward, what the Chinese are saying is that they are implementing a three-band system in which if the prices deviate from an expected 535 RMB, if they deviate more than 6% from that average, then the NDRC is likely to take actions or will take actions. If they deviate, in the green zone, they will not take action. They will let the system continue because there is no need to intervene. And then if prices deviate more than between 6% and 12%, they will actually start looking closely and deciding whether they will take action. And then there is a red range, which is beyond plus minus 12%. On either side, remember, they will also take actions on the way down because basically in China, as you could probably infer, is the coal industry is a critical element of the entire system. So in order to keep the coal industry healthy, and that goes a long way in many aspects, social and economical, they will not let the prices go down below a certain range. Now, on the way up, you could be hurting the utilities if prices are too high. So basically, we have now a price floor that's formed, and that equates at the very least to a Newcastle of 68 on the very bottom end of the range, and 80 on the higher end of the range. But volatility outside of that range is actually possible for relatively short periods of time. And so China, as a clearing market, is actually going to be providing for the years to come a very attractive sink in terms of additional supplies that don't find a home in the other more natural markets, I would say. Now, all of these saw prices go from a very low $50 at the front and backwardated $10 down. That was at the beginning of actually at the beginning of 2015. I think there's a bit something backwards on the chart. The blue one is 16, very backwardated beginning of the year, and terrible price. Basically forecasting the end of the industry at that point. Many actually call the end of the coal industry. So we saw the prices along the forward curve come up to where the green line is at the top there of the range. And that's the current market, and it's an entirely different market. It's a market that is actually still has a little backwardation that I dislike, because it's the wrong message to the industry, and this goes a bit more wide, but much more healthy than the market that we had a year ago. So now I'll keep it short, my own balance of India. And it's not to compete with Ashwani, but I have some discrepancies on the findings that he has. So let me show you where my demand goes. My demand numbers in terms of tons, he had 1350 or something in 2020. My number for 2020 is actually much lower than his number, so I'm at 1 billion. I reached over 1.4 billion by 2030. So if anything, I'm being more conservative than Ashwani, and it's based on assumptions there on slide number 12. And I guess if the presentation is made available later, you will be able to see that. And it's quite a simple energy mix and economic growth model, but basically it's not very aggressive in terms of demand. So we get there, on 2030, 1.4 billion. And then I point to this slide that I got from Wood Mackenzie actually in one of the latest releases, and to me it shows well. It shows how 2016 balanced, and to me it's very telling that actually Coal India did manage to get a little bit of growth, but the growth that they actually succeeded at was only 15 million tons. And then others actually remain very muted in terms of growth. And most of what you would say was growth in India last year in terms of sales supply, what came from stockpiles that were actually created on the year before, when Coal India actually did have a very good year. So it hasn't been a great last 12 months. For me to get particularly excited about my forecast of Indian coal production. Some people will argue that the issue was not supply but demand. If there had been more demand, then supply would have responded. I still have huge question marks. So the disagreement here is going to be, of course, and I do believe that I'm incredibly conservative on my numbers, but my model of coal supply has Coal India only reaching around the 750 mark by 2020. I do have a lot of doubt, and that's not a helicopter view that I have. I do have from the ground. I talk to people, and not many people would dare say that Coal India will reach that 1 billion. So I have them at 750, and I do have similar growth on Singareni as Ashwani has, and similar. I think I'm not entirely sure. I lost. I couldn't see his number there, but the captive is also has some aggressive growth. But what I get, the result that I get is interesting. So if you see the line, the orange line, what it's telling you is, yes, it's possible that India in the short term or mid-term, so if you put both things in perspective, the demand and the supply, it's possible that they manage to more or less peak demand in year 2014, and probably even take it back a few years, so stop the growth. But actually, what we do get very strong on this model, and it doesn't matter what we do, it has to do with quality, it has to do with power plant efficiency. It's very difficult to keep the model away from dispatching imports and needing imports. And what happens is in 2020, imports start to grow again. And we ran quite a few scenarios on this, and I mean, you can change numbers and you can change a little bit the level of the orange line. What you do always get is that comeback of India into the import market. So in terms of in India being friends of foe or foes of the international market, we believe that you should remain friends of the international market. Now, when it comes to the rest of the picture, so other regions and countries, etc. So doing a demand balance, we have actually an important observation. Recently, we did some work on Africa, and we see growth of almost 40 million tons over the next 15 years in Africa, and that's coming online quite quickly, and that's spread over quite a few countries. And some of those projects are already permitted. So we do see, with a high level of certainty, 40 million tons of demand from Africa coming in, and that has an important impact, and that's the impact that it has in South Africa. If you look at the way South Africa sells its coal today, we believe that it's going to change very deeply over the coming years. So what I mean is, today South Africa sells 50% of its coal to India, and another 25% to Europe, and other destinations 25%. So what we believe is going to happen in Africa over the coming years is this major change. At that point, so let's say anywhere between 2025 and 2030, 80% of South African coal exports will become regional. And when I mean regional, I am including the Middle East as a vicinity, but Africa will be taking 38 million tons out of 80, so almost 50% of the South African exports will be taken by Africa, and I don't mean domestic in South Africa, I mean other African countries taking seaborne coal. And we also have a sizable number in the Middle East. So what you are going to have left for South Asia is going to be 8 million tons, which is almost the level of demand that Pakistan has today for South African coal. So it makes you start to wonder what's going to be left for India. And that's winding Europe down to 6 million tons, and perhaps we could see a bit more demand from Turkey and argue other things. But I hope I make the point that I don't think we can take South African coal for granted in terms of flows. Now, other regions will also provide some support to the market, and overall talking about prices, that would be Southeast Asia. So if you run a similar model to what we did in India for Southeast Asia, you get that the market will be 250 million tons by 2030. That's 50% bigger than the whole of the Atlantic market will be. So we have one market that today 70 million tons will become about 25% of or 22% of the total seaborne coal market, and the European market will just decline slowly, except for the Mediterranean and the Middle East. So the whole energy stack that we have in terms of coal demand by region shows this trend, and we see actually seaborne coal demand growing to over 1.3 billion tons by 2030. Conveniently a similar number to what we have for India itself. And this is the distribution that we see and where we see the growth. So we see some upcoming regions, and we see some of the classic stuff in there. So China, it's more relatively stable, but we have a lot of other regions, very solid base demand from North Asia. So that's what we get. And overall, if we plug the numbers together and we play a little bit with, and this is just to discuss a concept here, if we play with the supply, and if we think about Indonesia, which is I'm a big defender of this concept. Probably some people that have heard me before always hear me talk about Indonesia. And it's that the concept is that I believe that Indonesian exports have already peaked, and that you actually cannot take for granted that after 2020, once all the mines are converted from CCOWs to IUPs, you're going to continue having a big ramp up in Indonesian production anytime you need it. Especially if the volumes that we see on this slide highlight that by 2030, the market is going to be short 500 million tons in terms of seaborne coal availability. And that's not to exaggerate, but it's to drive the point that the slide is made without any new capacity, without adding any capital investment into the cost curve. So, you know, this boils down to whether those greenfield projects in Australia will happen or not. It seems from the result that we get that they are needed. Actually, there is a lot going on this slide, and I encourage you to actually look at it and send me an email asking questions if you want. You could actually argue some on the South African number, whether it's not going down, why Colombia is tapering off. I'm not going to tell you all the answers here. I think I could answer most of it, or at least debate most of it, but I'll leave it to you to come back if you have more questions. So now, just to close, because I spoke too much, just to close the presentation, I'm showing here the supply-demand balance and the shortage and the conclusion. And the conclusion is that by 2020, we're quite confident that the global demand footprint and that's including only projects that are highly likely to happen, almost unavoidably happen, will exceed the available supply in the market, where we are not seeing by far not enough investment in terms of trying to bring coal projects online successfully, and there is a lot of resistance from many outside the coal industry, I guess, trying to stop mines from coming online. I would like to argue actually asymmetrical influence in the industry in which it seems that coal-fired power stations are being more successful projects than mines. Mines get more hatred from everybody, and it just becomes very difficult to open one, and it's easier to actually have a coal-fired power plant, it seems. So that most of the conclusions revolve around that and shortages of quality. So with that, I'm going to now leave you and open the floor for questions if Harry wants. Thank you.
Great, thank you very much for that presentation, Rodrigo. This is just a reminder to everyone who's watching, you can put questions in on the side. We've already had quite a few in. This one is actually for you, Ashwani. We've got someone asking, how do you think Indian power plants will be able to cope with the ash generated by utilizing more domestic coal? Considering that at present ash utilization is only around 50%, mainly in cement companies, and power plants are finding it difficult to dispose of their ash, do you think it will be an increasing problem as power plants increasingly use more domestically sourced high ash coal?
It's a good question. In fact, if you see that Indian regulations also do not allow transportation of certain types of coal, which are more in terms of ash percentage, and there is a restriction on the transportation of those types of coal. Yes, ash, but if you see that Indian power plants by design are basically, they can handle, because they are designed on domestic coal, majority of the power plants, they can handle ash. The problem is with the import-based import coal-based power plants. And as I said in my presentation, that Government of India is putting up a lot of thrust on these power plants also to use domestic coal. So one of the options which has been given to these plants is that they use it as a blend, say 5%, 10% blend. And probably I feel that this question is in context with the replacement of domestic coal, with replacement of imported coal with domestic coal. So I'm answering this in that context. So and there are lots of mines which we have, particularly in Eastern coalfields and in SECL also, as I was mentioning in my presentation, wherein ash percentage is quite low, maybe around 17, 18%, not more than that. So those coals are quite suitable for import substitution for the power plants located on the coast.
Great. Okay. Thanks, Ashwani. Rodrigo, we've got a question for you regarding the Chinese price range that you mentioned, that they effectively were putting a cap and a floor on. And we've got a question asking how permanent that floor and cap is, and if demand grows from Southeast Asia and Africa, like you suggest, what will be the Chinese response? Would they boost production to limit prices, and how long will they seek to keep the price within that range?
Yeah, that's everyone's favorite. In terms of how permanent the range is, I would say the concept, the foundation of that range, or the motivation to have that range there, is permanent. It is permanent because they need a functional coal industry, and it's not about, this doesn't have anything about to do with the international industry. It's not China doing favors to anyone. It's simply the Chinese industry responding to save itself, and the government, well, having high stakes in the coal industry, helping them keep their financial obligations, keep employment, etc. So I would say we will, until the market rebalances, because, okay, the range itself doesn't have to be there forever, but what you will see is that they will continue to try to rebalance the market. So this is a several fronts. One is also the capacity. So they will continue to eliminate excess capacity, inefficient capacity, quasi-legal capacity. So they will continue to cut on all of those fronts, which is what they were doing before the ranges. The ranges came basically because all those approaches were not really working in terms of pricing. So it becomes a bit of a, I guess it becomes a never-ending and pointless question if we discuss, you know, how many working days you're going to put and how many you're not going to put and when you, it doesn't matter. You know that the Chinese industry does not work below mid 500 RMB in terms of cost because the domestic production in China is actually not cheap. And that I refer to the person asking the question to any of the regular publication to check the cost curve in China, which because that is what explains a lot of things. Actually, it makes you realize what is the real problem, and it's not where the 535 came from, which seems like an arbitrary number, but it actually has a very good logic behind it in terms of bringing the coal companies back to black in territory in the quarterly statements and avoiding what was going to become a catastrophe in the system in China. So yeah, the short answer is that should be a pretty permanent price situation.
Okay, thanks, Rodrigo. We've got another question for you. This one's actually been signed. This is from Gary from Sydney, if you know who that is. So, Rodrigo, this question is, does your modelling include supply from the Adani project? And if so, what timing do you expect for the coal to come online?
Does the modeling include what? Sorry, the Adani project, that's Carmichael, and that's... Yeah. So it's not explicitly included there, and I don't mean to talk about in favor of any one party, but what I would say is that the projects of this nature, if you are to believe the demand numbers and the supply number that I have there, and there is a rationale behind all of them, projects of that nature will be needed. If you do not have, these are some of the only few projects that you can actually develop in the seaborne market. So if what the model suggests is the absence of developments like that one, so new greenfield mines will actually result in a coal market that will be permanently undersupplied. So I would say yes, there is room for projects of that nature, and I hope that makes Gary happy enough.
We hope so too. Okay, Ashwani, we've got a question for you here. Yeah. So as the import patterns develop, the question is, will the quality spread of imports change, and also will Indonesia remain a primary supplier to India? Will the import basket in terms of sourcing look different now?
See, it's a very good question, and probably one part of it is still sub judice, because if you see the big power plants like Adani and Tata Power, Essar Power, all of them were based actually on Indonesian coal. And as you know that there were tariff agreements which they have signed. These tariff agreements were signed on 25 years of consistent supply at fixed prices for Indonesia, which has not happened. And there are some legal developments which are happening on in terms of maybe some revision in the tariffs for these 3-4 companies. And if that happens, then yes, definitely Indonesia is going to remain as a dominant source of coal for India. And see, again, we will have to see it sector-wise. If we look at cement sector, probably majority of the coal which is being used for kiln was already replaced by petcoke. And if we talk of sponge iron industry particularly, majority of the coal was coming from South Africa. And we can say that for power generation it was Indonesian. But of course it will depend upon the price, how the international coal prices move. And this is what I have been suggesting to each and every coal supplier of mine, that if the prices keep on hovering, what we saw in last 3-4 months, particularly for South African or Australian coals, then people will tend to find alternatives, and that is exactly what has happened also. Let's take an example of sponge iron industry. South African prices went up so high that sponge iron industry suddenly decided not to pitch for that coal, and they have moved to domestic coal. And Government of India, also looking at this opportunity, came up with e-auctions for linkages, and majority of these companies have now applied for the linkages, and some of them have already got it. So that means those volumes have South African coal have already got replaced. Number one. Number two, yes, imports will always be a function of price and quality. And it is a matter of probably it will always remain a function of up to what kilometers the imported coal can flow. And I feel that at this price, at current price levels, probably we are more inclined in using domestic coal rather than importing coal.
Okay, thanks, Ashwani. So we've got another question for Rodrigo now here regarding the growth of renewables in both China and India, and to what extent really do renewables pose a political risk, and how are they balanced in your model?
Okay, so two very different answers, one for China and one for India. Let's answer India. So if you look at the charts that I did and the way I supply the electricity sector in India, the growth that I include for renewables there is very, very aggressive. In terms of terawatt hour, I actually managed to dispatch about 20% of the energy of the whole country based on renewables, which would be a magnificent achievement for India. So I do think that to the most realistic extent, I have included renewables on the Indian side. On the China side, we do know that they will continue to make gigantic efforts because they have more than one problem on that front. So they have a pollution problem and many things. I mean, the system has to improve in a number of ways. It's a huge industrialized country with a very big demand base. So they have actually been addressing that. They have installed already a lot of hydro, and they install wind, massive quantities of wind every year, etc. But if the question of renewables is to try to make an inference of what the Chinese price would be under that scenario, I actually think there is an economics issue there, and it's that the Chinese domestic price has ceased to be based on the actual level of demand of China, because once you have a government that is showing the intention of stabilizing prices at a certain level that allows the industry to continue, you have in a way eliminated eliminated supply-demand balance uncertainties. So what it really becomes more of a policy mandated price level. So I guess ultimately the spirit of the question would be, I would there rephrasing, do I believe that upcoming renewables in China could bring domestic coal prices down? And I don't think so, because the system just doesn't work like that.
Okay, well, that's just about all we've got time for. So I'd just like to say thanks, Rodrigo and Ashwani, again for your presentations. And thanks to everyone who's joined us for today's webinar. We hope you found it informative, and if you're keen to learn more, please do join us for Coal Trans India, which is next month, taking place on the 20th to the 22nd of February. That's at the Taj Palace in New Delhi. With regards to the slides from these webinars, these will be uploaded to the Coal Trans website within 48 hours, and you should get an email about that. And like I said, we hope you enjoyed the webinar, and thanks again to Rodrigo and Ashwani. Thanks again, everyone.
Thank you very much.
Thank you.
Thanks. Okay. Bye-bye.